Hi, welcome to iEducator. This is Teacher Jeff. I'm an educator and an engineer by profession. And today we will discuss Chapter 1. And Chapter 1 is all about the introduction to financial accounting. And in today's lesson, there are five key areas that I'm going to be highlighting today. First, we have the accounting definition. Second, we will be discussing about business organizations. Third, we have generally accepted accounting principles or the GAAP. Fourth, we have the different financial statements or the basic financial statements. And finally, we have transaction analysis and double entry accounting. Now, in order for us to get started, let us go over to our first key area of our lesson for today, which is the accounting definition. Before we define accounting, you have to take note that accounting involves a process of collecting, recording, and reporting a business's economic activities to users. It is often called the language of business. Why the language of business? Because accounting uses a unique vocabulary to communicate information to decision makers. And to understand accounting, we actually first look at the basic forms of business organizations. And from there, the concepts and principles that provide the foundation for financial accounting are then discussed, and with an emphasis on the corporate form of business organization. We will also examine how we communicate to users of financial information using the different basic financial statements. And finally, we will also review how financial transactions are analyzed and then reported on financial statements. So, what is meant by accounting then? Well, if we see accounting, it is the process of identifying, measuring, recording, and communicating an organization's activities to users. And users need information for decision making. So, who are these users then? Well, as a brief recap on your accounting one subject, there are two users of financial information. First, we have the internal users, and second, we have the external users. Take note that internal users of accounting information work for the organization and are responsible for planning, organizing, and operating the entity. Now, if we say managerial accounting, this is actually the area of accounting that serves as the decision making needs of the internal users. And examples of internal users are the different managers of the organization. We have the finance manager, the accounting manager, the production manager, the marketing manager, the sales manager, and any other managers inside the organization who need financial information which they can use in their daily activities. And aside from that, we also have external users. And take note, external users do not work for the organization. They include investors, creditors, labor unions, research scholars, customers, and many others. And take note that financial accounting is the area of accounting that focuses on external reporting and meeting the needs of external users. Now, the next key area that we're going to be highlighting today, that would be the business organization. And if we say organization, it is a group of individuals who come together to pursue a common set of goals and objectives. In other words, it is the means used by people to achieve certain objectives. And there are two types of business organizations. First, we have a profit seeking organization, And second, we have non-for-profit seeking organization. If we say profit-seeking organization, these types of organizations usually sell products and or services for profit. Examples of that would be Coca-Cola Corporation. They manufacture bottled soft drinks like Coca-Cola products. And aside from that, we also have Gardenia. Okay, so they manufacture loaf breads and other breads, types of breads as well. On the other hand, if we say non-for-profit seeking organization, examples of these are charity or hospitals. We also have churches. As you can see on our example, we have PCSO or Philippine Charity Sweepstakes Office, and we also have churches. They exist to meet various societal needs and does not have profit as a goal. So in general, all businesses, regardless of type, record, report, and most importantly, use the accounting information for making decisions. Now, there are three common forms of business organizations. We have the sole proprietorship, we have the partnership, and we also have the corporation. If we say sole proprietorship, it is a business owned by one person. And aside from that, it is not a separate legal entity, and it also has unlimited liability. So in this case, it is not a separate legal entity because it means that the business and the owner are considered to be the same entity. This means, for example, that from an income tax perspective, the profits of a proprietorship are taxed as part of the owner's personal income tax return. And on the other hand, it is unlimited liability because this is another characteristic of a sole proprietorship, meaning that if the business could not pay its debts, the owner would be responsible even if the business's debts were greater than the owner's personal resources. And aside from that, we also have partnership. And if we say partnership, this is a business owned by two or more individuals. And one of its characteristics is that it is not a separate legal entity. Now, like the proprietorship, it is not a separate legal entity, and its owners are typically subject to unlimited liability. And finally, the last form of business organization, that would be corporation. And if we say corporation, it is a business owned by one or more owners, and the owners are known as shareholders. So what do we mean by shareholder? A shareholder actually owns shares of the corporation. And if we say share, these are units of ownership in a corporation. For example, if a corporation has 1,000 shares, there may be three shareholders where one has 700 shares, another has 200 shares, and the third has 100 shares. And the number of shares held by a shareholder represents how much of the corporation they own. So a corporation can have different types of shares, and this topic is discussed in a later chapter. And when there is only one type of share, it is usually called as common shares. Now, there are two types of corporation based on how its shares are offered. First, we call that as private enterprise or PE, and the second one is called publicly accountable enterprise or PAE. Now, what's the difference between the two? Now, here's the thing. A corporation's shares can be privately held or available for public sale, and a corporation that holds its shares privately and does not sell them publicly is known as a private enterprise or PE. And a corporation, on the other hand, that sells its shares publicly, typically on a stock exchange, is called a publicly accountable enterprise, or PAE. Now, one example of private enterprise, or PE, that would be a Koch Industries Incorporated in the United States. And in the publicly accountable enterprise, or PAE, one example that would be ABS CBN Corporation, because they actually sell their shares publicly. Okay. And aside from ABS CBN, we also have GMA Incorporated, and we also have JFC, or Jollibee Foods Corporation. We have Ayala Lands, we have SM Holdings, and so on and so forth. And going back, some of the characteristics of corporation, we have a separate legal entity, and we also have limited liability. Why is that so? Well, unlike the proprietorship and partnership, a corporation is a separate legal entity. This means, for example, that from an income tax perspective, a corporation files its own tax return, and the owners or shareholders of a corporation are not responsible for the corporation's debts, so have limited liability, meaning that the most they can lose is what they invested in the corporation. Now, as you can see in figure 1.1, it shows an example of the delegation of responsibility under corporation from under corporation form of business organization. And take note that in larger corporations, there can be many shareholders. And so for that matter, shareholders do not actually manage a corporation, but participate indirectly through the election of a board of directors, or BODs. So what they usually do is that they elect board of directors, and remember, these board of directors do not participate in the day-to-day management of the corporation. So having said that, what they actually do is they appoint officers of the corporation and delegate them the said responsibilities. And shareholders usually meet annually to elect a board of directors. And the board of directors meets regularly to review the corporation's operations and to set policies for future operations. Unlike shareholders, directors or BODs can be held personally liable if a company fails. Okay, so that ends our discussion for the second key area. Now, the next key area that we're gonna be discussing right now, that would be the GAAP, or the generally accepted accounting principles. Now, the goal of accounting is to ensure information provided to decision makers is useful. Now, in order to be useful, information must be relevant and faithfully represent a business's economic activities. This requires ethics. Now, if we say ethics, this refers to beliefs that help us differentiate from right or wrong, and in the application of underlying accounting concepts and principles. And these underlying accounting concepts or principles are known as generally accepted accounting principles, or GAAP. So if we say GAAP, these are a set of rules that encompass the details, complexities, and legalities of business and corporate accounting. GAAP in Canada, for example, as well as in many other countries, is actually based in International Financial Reporting Standards, or the IFRS, for Publicly Accountable Enterprises, or PAE. IFRS are issued by the International Accounting Standards Board, or the IASB. But what about here in the Philippines? Well, in case of the Philippines, same with Canada and other countries, the Philippines has adopted the International Financial Reporting Standards, or IFRS as the Philippine Financial Reporting Standards for what we call as PFRS, except on the aspect of revenue recognition under IFRS 15 for real estate companies that avail of the relief granted by the Securities Exchange Commission or the SEC. Companies doing business in the Philippines must comply with the Philippine Financial Reporting Standards, and the PFRS is a set of generally accepted accounting principles or GAAP issued by the Accounting Standards Council or ASC to govern the preparation of financial statements. And these standards aim to promote fairness, transparency, and accuracy in financial reporting. And so, for that matter, these are what we use or what we apply here in the Philippines. And so, to ensure compliance with the above mentioned standards, or with the aforementioned standards rather, it is ideal for a company doing business in the Philippines to have an accounting manual or process flow or documentation and recording guidelines in relation to proper cash management, proper inventory management, proper fixed asset management, proper order to cash or OTC management, and we also have proper purchase to pay or P2P process. Now, information that possesses the quality of relevance has the ability to make a difference in decision making process. And if we say faithful representation is complete, neutral, and free from error. Comparability tells users of the information that businesses utilize similar accounting practices. So that is why it's called comparability. You are able to compare your own company standards to your peer group. And another, we have verifiability, means that others are able to confirm that the information faithfully represents the economic activities of the business. And another quality that an information should possess, that would be timeliness. Timeliness is available to decision makers in time to be useful. And finally, we have understandability. If we see understandability, it is clear and concise as much as possible. And so, for that matter, accounting practices are guided by GAAP, which are comprised of qualitative characteristics and principles. And you have to bear in mind as well that relevance and faithful representation are the primary qualitative characteristics. And on the other hand, comparability, verifiability, timeliness, and understandability are additional qualitative characteristics. Now, as you can see in table 1.1, it shows how the 9 principles that support these qualitative activities. Now, one accounting concept or principle, we call it as business entity. So this is just a brief recap of your accounting one subject. So what is meant by business entity accounting principle? Now, if we say business entity, it means to say that it requires that each economic entity maintain separate records. For example, a business owner keeps separate accounting records for business transactions and for personal transactions. This further means that if you are the owner of the company, you cannot include your own personal transactions to the business transactions. In other words, it should be separate. And another accounting concept and principle, that would be consistency. And consistent requires that a business use the same accounting policies and procedures from period to period. For example, a business uses a particular inventory costing method, and it cannot change to a different inventory costing method in the next accounting period, meaning to say you need to be consistent. So if the inventory costing method is perpetual inventory costing method that you used last year, that means to say that that should be the inventory costing method that you will be using the following year. Okay, there should be consistency. And another business entity, or I'm sorry, another accounting principle and concept rather, that would be cost. And cost requires that each economic transaction be based on the actual original cost, or also known as historical cost principle. For example, the business purchases a delivery truck advertised for $75,000 and pays $70,000. Now, the truck must be recorded at the cost of $70,000, the amount that your business actually paid for. Okay, you cannot record 75 because you only paid $70,000 for it. Okay, and therefore you should be using $70,000 instead. And another accounting concept or principle that would be full disclosure. And full disclosure means that it requires that accounting information communicates sufficient information to allow users to make knowledgeable decisions. Now, in order for us to better understand this, let me have an example. So, for example, a business is applying to the bank for $1 million loan. Now, the business is being sued for $20 million, and it is certain that it will lose. The business must tell the bank about the lawsuit, even though the lawsuit has not yet been finalized. So, you need to disclose that information to the bank, even if the lawsuit has not finalized as of yet. Okay? And the next accounting principle or concept that would be going concern. And if we say going concern, it assumes that a business will continue for the foreseeable future. For example, all indications are that business X will continue, so it is reported to be a going concern. Business Z, on the other hand, is being sued for $20 million, and it is certain that it will lose. The $20,000 loss will force the business to close. Now, business Z must not only disclose the lawsuit, but it must also indicate that there is a going concern issue. So the next accounting concept and principle, we have the matching principle. And matching principle requires that financial transactions be reported in the period in which they occurred or were realized. Again, it requires that financial transactions should be reported in the period in which they occurred or realized. For example, supplies were purchased March 15 for $700. They will be recorded as an asset on March 15 and then expensed as they are used. So since it was realized on March 15, so that would be the date in which you will be recording that certain account, okay, in your book of accounts. And we also have materiality principle. And if we say materiality principle, it requires a business to apply proper accounting only for items that would affect decisions made by users. Now, in order for us to better understand this, let us have an example. So, for example, the business purchases a stapler for $5 today. Technically, the stapler will last several years, so should be recorded as an asset. However, the business will record the $5 as an expense instead, because depreciating a $5 item will not impact the decision of financial information. Okay, so you should be materialistic. And what I mean about that is that you should weigh in your options if it would affect your decision or not. And the next accounting principle or concept that we have, that would be monetary unit. And when we say monetary unit, it requires that financial information be communicated in stable units of money. For example, land was purchased in 1940 for 5,000 Canadian dollars. It is maintained in the accounting records at 5,000 Canadian dollars and is not adjusted. So you should stay that one as is. You purchased that 5,000, so you should record that one as 5,000 as well. And another, we have the recognition principle. And recognition principle requires that revenues be recorded when earned and expenses be recorded when incurred, which is not necessarily when cash is received in the case of revenues or paid in the case of expenses. For example, a sale occurred on March 5. Now, the customer received the product on March 5, but will pay for it on April 5. Okay, so that would be 1 month after. So the payment will be made 1 month after. The business records the sale on March 5 when the sale occurred, even though the cash is not received until April 5. Okay, so meaning to say, since the sale was made on March 5, so you recorded that one, you recognized that one as March 5. So you made your recording on March 5, even though the payment will be made after a month. Okay, so that's recognition principle. All right, so the next key area that we're gonna be discussing next, that would be financial statements, or the basic financial statements. Now, why is it that financial statements are of paramount importance for decision makers? Now, you need to recall that financial accounting focuses on communicating information to external users, and that information is communicated using financial statements. Now, there are four financial statements. First, we have the income statement. Second, we have the statement of changes in owner's equity. Third, we have the balance sheet. And finally, we have the statement of cash flows. Okay, let us have income statement first. So what is meant by income statement? If I say income statement, this statement or financial statement communicates information about a business's financial performance by summarizing revenues less expenses over a period of time. Now, as what you had learned in your accounting one or basic accounting subject, take note that the two keywords that we should always remember if we talk about income statement are revenues and expenses. Now, just a brief recap though. If we say revenues, these are created when a business provides products or services to a customer in exchange for assets. And remember, assets are resources resulting from past events and from which future economic benefits are expected to result. Now, as you can recall, assets are classified into three. We have the current assets, we have the fixed assets or non-current assets, and finally we have other assets. If we say current assets, these are the types of assets that are liquid in nature. These include cash, accounts receivable, prepaid expenses, inventories, etc. On the other hand, fixed assets or non-current assets are long-term assets that a company has purchased and are used for the production of its goods and services. Now, take note, fixed assets are also known as non-current assets, meaning the assets have a useful life of more than 1 year. And fixed assets include property, plant, and equipment, or PP&E. And lastly, we have other assets or intangible assets. And if we see other assets, these are the types of assets that are those that are not physical in nature. Examples of these are goodwill, brand recognition, and intellectual property, such as patents, trademarks, and copyrights. And also, recall that expenses are the assets that have been used up or obligations incurred in the course of earning revenues. Now, when revenues are greater than expenses, then the difference is called net income or profit, meaning to say the company or the business is earning. On the other hand, when expenses are greater than revenue, a net loss results, meaning to say the company or the business is incurring a loss. They are not earning. Okay? So, in order for us to better understand that, I have prepared here two examples. The first example, which is in green one, on the left side, this is Paul's Guitar Shop Incorporated. Okay, that's the name of the company, and followed by the name of the statement. In this case, we have income statement, and the next is the time frame for the year ended December 31st, 2015. Now, as you can see on the bottom part, the resulting value is positive. Okay, as you can notice, you have there encircled net income amounting to $12,950. So, meaning to say, the company is earning because its revenues are higher than its expenses. On the other hand, on the other example, highlighted in gray, in my right side, if you try to look at the bottom portion, you can see their loss, okay, net profit or loss. Because as you can notice, the revenues are lesser than the expenses. The total revenues you have there 2,400, and the total expense is 8,450. That is why the company is incurring a loss, which is a negative 6,050. So normally in accounting, if it's negative, this is usually enclosed in a parenthesis. Okay, so that's the difference between positive or earning or net income or profit and negative or loss. Okay, another type of statement, financial statement, we have statement of changes in owner's equity. And this statement provides information about how the balances in share capital and retained earnings changed during the period. If we say share capital, it is a heading in the shareholders' equity section of the balance sheet and represents how much shareholders have invested. Now, when shareholders buy shares, they are actually investing in the business. And the number of shares they purchase will determine how much of the corporation they own. Now, the type of ownership unit purchased by Big Dog's shareholders is known as common shares. And other types of shares will be discussed in a later chapter. And also, we need to remember that when a corporation sells its shares to shareholders, the corporation is said to be issuing shares to shareholders. Now, in order for us to better understand statement of changes in owner's equity, let me show you an example. So as you can see, this is an example of statement of changes in owner's equity. As you can notice, share capital and retained earnings balances at January 1 are zero, right? Now, this is because the corporation started the business on that date. And during January, share capital of $10,000 was issued to shareholders. So the January 31st balance is $10,000. Now, if we say retained earnings, this is the sum of all net incomes earned by a corporation over its life. less any distributions of these net incomes to shareholders. And distributions of net income to shareholders are called dividends. So in order for us to better understand this, in simple words, if we say dividend, it is a portion of profit after tax that is given out to shareholders. And whatever is left is called retained earnings. And these earnings are retained by the company for the purpose of reinvesting it back in the company for growth or expansion purposes. Now, going back to our example, take note that shareholders generally have the right to share in dividends according to the percentage of their ownership interest. Now, to demonstrate the concept of retained earnings, recall that Big Dog has been in business for 1 month in which 2,200 of net income was reported. Additionally, $200 of dividends were distributed. So these are subtracted from retained earnings. So Big Dog's retained earnings were therefore $2,000 at January 31st, 2015, as shown in our example. Now, to demonstrate how retained earnings would appear in the next accounting period, let's assume that Big Dog reported a net income of $5,000 for February or for February 2015, and dividends of $1,000 were given to shareholder. Now, based on this information, retained earnings at the end of February would be $6,000, calculated as $2,000 January 31st balance plus the $5,000 February net income less the $1,000 February dividend. And the balance in retained earnings continues to change over time because of additional net incomes or losses and dividends. Okay, so that is what statement of changes in owner's equity is all about. And the next financial statement that we will be discussing, that would be balance sheet. And take note that balance sheet is also known as the statement of financial position or the statement of financial condition because it shows a business's assets, liabilities, and equity at point in time. Now, in order for us to better understand how balance sheet would look like, now as you can see in our example, this is still Big Dog Car Works Corporation's companies or balance sheet rather. So as at January 31st or as of January 31st, 2015. Now, in balance sheet, your assets should always be equal to your liabilities plus owner's equity. And as you can notice, your assets are located at the left side and your liabilities plus owner's equity are located in the right side. So as you can see, this is an example of the balance sheet of Big Dog Car Works Corporation as of January 31st, 2015. Now, as what we discussed in your accounting one or basic accounting subject, we learned that every time we talk about balance sheet, there are three keywords that we should always remember. First, we have assets. Second, we have liabilities. And third, we have owner's equity. Also, in balance sheet, we make use of the accounting equation, which is assets equals liabilities plus owner's equity. So what is meant by assets, liabilities, and owner's equity then? Now, just a brief recap. If we say assets, these are economic resources that provide future benefits to the business. Now, as discussed earlier, assets are classified into three. We have current assets, fixed assets or non-current assets, and we also have other assets. If we say current assets, these are the types of assets that are liquid in nature. These include cash, accounts receivable, prepaid expenses, inventories, and many others. On the other hand, fixed assets are long-term assets that a company has purchased and are used for the production of its goods and services. And this is also known as non-current assets, meaning the assets have a useful life of more than a year. And fixed assets include PP&E, or property, plant, and equipment. And lastly, we have other assets or intangible assets. And these types of assets are those assets that are not physical in nature. Examples of these are goodwill, brand recognition, and intellectual property, such as patents, trademarks, and copyrights. On the other hand, if we see liabilities, these refer to an obligation to pay an asset in the future. And liabilities are classified into two. First, we have current liabilities or short-term liabilities. And second, we have non-current liabilities or long-term liabilities. If we say current liabilities, these are liabilities that are due and payable within a year. Now, common types of short-term debt or liability include short-term bank loans. We have accounts payable. We have notes payable, salaries payable, income taxes payable, and many others. On the other hand, non-current liabilities or long-term liabilities are liabilities that are due after a year or more. And common types of long-term debt are bonds payable, debentures, long-term loans, deferred tax liabilities, pension obligations, etc. And finally, we have equity or owner's equity. And if we say owner's equity, this represents the net assets owned by the owners. And examples of equity that would be share capital and retained earnings. Net assets are assets minus liabilities. For example, in Big Dog's January 31st balance sheet, net assets are $12,000, calculated as total assets of $19,100 minus total liabilities of $7,100. This means that although there are $19,100 of assets, only $12,000 are owned by the shareholders, and the balance $7,100 are financed by debt. And notice that net assets and total equity are of the same value, right? Both are $12,000. So what does equity consist then? Well, it consists of, like I said earlier, share capital and retained earnings. And if we say share capital, it represents how much the shareholders have invested in the business. On the other hand, retained earnings is the sum of all net incomes earned by a corporation over the life, less any dividends distributed to shareholders. All right, so the next statement that we're gonna be discussing today, that would be the statement of cash flows. And statement of cash flows explains how the balance in cash changed over a period of time by detailing the sources or inflows and uses or outflows by cash by type of activity. Now, in statement of cash flows, there are three different activities that we should always remember. First, we have the operating activity. Second, we have the investing activity. And finally, we have the financing activity. So what's the difference between the three? If we say operating activities, these are the day-to-day processes involved in selling products and or services to generate net income. Now, examples under operating activities that would include the purchase and use of supplies, paying employees, fueling equipment, renting space for the business, and a lot more. On the other hand, if we say investing activities, these are the buying of assets needed to generate revenues. For example, when an airline purchases airplanes, it is investing in assets required to help it generate revenue. And finally, if we say financing activities, these are the raising of money needed to invest in assets. Financing can involve issuing share capital or getting money from the owners known as shareholders. And aside from that, we also have borrowing, or we can get a loan from financial institutions or any banks. Now, as you can see in figure 1.2, it summarizes the interrelationship among the three types of business activities. We have the operating, the investing, and the financing activities, respectively. Now, as you can see, this is an example of the statement of cash flows of Big Dog Car Works Corporation. As you can see, you have their operating activities, investing activities, and financing activities, respectively. Now, in the right corner, you have there the respective figures of each list of activities, right? As you can notice, there are figures without parentheses, and there are also figures that are enclosed with parentheses. Now, those without parentheses represent cash inflows, and those enclosed with parentheses represent cash outflows. And you have to take note as well that the statement of cash flow is useful because cash is one of the most important assets of the corporation. Information about the expected future cash are therefore important for decision makers. For instance, Big Dog's bank manager needs to determine whether the remaining $6,000 loan can be repaid, and also whether or not to grant a new loan to the corporation if requested. And therefore, the statement of cash flows helps inform those who make these decisions. All right. And finally, the last financial statement that we're going to be discussing today, that would be notes to financial statements. As essential parts of financial statements are the notes that accompany them. And notes to financial statements are generally located at the end of a set of financial statements. It provides greater detail about various amounts shown in the financial statements, or provide non-quantitative information that is useful to the user. For example, a note may indicate the estimated useful lives of long-lived assets or loan payment terms. Okay, so those are just some of the many examples of notes to financial statements. And the next key area that we're going to be discussing today, that would be transaction analysis and double entry accounting. Now, remember that the accounting equation is foundational to accounting, correct? It is foundational to accounting because it shows that the total assets of the business must always equal to the total claims against those assets by creditors and owners. Now, the accounting equation is expressed as assets equals liabilities plus owner's equity. Assets are those economic resources owned by the business. Liabilities are creditors' claims on assets. So this refers to your debts. And equity, these are the owner's claims on assets. Now, when financial transactions are recorded, combined effects on assets, liabilities, and owner's equity are always exactly offsetting. This is the reason why the balance sheets always balances, and each economic exchange is referred to as financial transaction. And for example, when an organization exchanges cash for land and building, that's an example of a financial transaction. Another example would be incurring a liability in return for an asset. This means that instead of paying cash for land and buildings, an organization may borrow money from financial institutions, and in return, the company must repay this with cash payments in the future. And therefore, the accounting equation provides a system for processing and summarizing these sorts of transaction. And second, accountants view financial transactions as economic events that change components within the accounting equation. These changes are usually triggered by information contained in source documents, such as sales invoice and bills from creditors, that can be verified for accuracy. Now, the accounting equation can be expanded to include all the items listed on the balance sheet of Big Dog at January 31st, 2015 as follows. So under assets, you have cash plus accounts receivable plus prepaid insurance plus equipment plus truck. And for liabilities, we have bank loan plus accounts payable plus unearned revenue. And for equity, you have shared capital plus retained earnings. Now, if one item within the accounting equation is changed, then another item must also be changed to balance it. In this way, the equality of the equation is maintained. For example, if there is an increase in an asset account, then there must be a decrease in another asset or a corresponding increase in a liability or equity account. This equality is the essence of double entry accounting. Now, the equation itself always remains in balance after each transaction. Now, in order for us to better understand how double entry accounting works, let me show you an example. So, this is our example for double entry accounting. So as you can notice in the first column, you have there the transaction number, followed by the date, followed by the description of transaction, followed by the assets, liabilities, and owner's equity, which is our accounting equation. So our goal here is to determine whether or not which account may have an effect towards our assets, liabilities, and owner's equity. And another goal that we have here is to determine if they really will equal at the end. Okay, so to start with, let's have January 1st transaction. So what happened in the 1st of January? Big Dog Car Works Corporation issued 1,000 shares to Bob Baldwin, the owner or shareholder, for $10,000 cash. Now, remember that we are given transaction, right? So in order for us to be able to determine as to which account has an effect towards our assets, liabilities, and owner's equity, we need to analyze the transaction first. And in analyzing the transaction, we need to be able to determine which accounts are involved in that specific example. Now, let's have our transaction number one, or the January 1st transaction. It says Big Dog Car Works Corporation issued 1,000 shares to Bob Baldwin, the owner or shareholder, for 10,000 cash. Now, remember, cash is an asset, right? This is a current asset. Okay, this is the most liquid current asset. So the asset cash is increased because we received $10,000 cash. Okay, while the equity item is the share capital because it says that the company, Big Dog Car Works Corporation, issued 1,000 shares. And this will also increase because we received 1,000 shares from the company. Okay, so the impact, what will be the impact on the equation then? So for the cash, since it will increase, so that will be affecting our assets. So plus 10,000. And for the share capital, remember that under equity is share capital, right? So share capital is also plus 10,000. On the 2nd of January, which is our second transaction, Big Dog Car Works Corporation borrowed $3,000 from the bank and deposited the cash into the business bank account. Now, remember, if you borrow or if you loan money from the bank, meaning to say you receive cash, right? So that will increase your asset. So that is why you have there plus 300 under asset, okay? Because cash is an asset. And since you get a loan from the bank or from a financial institution, so that would be a bank loan. And bank loan is a liability. It is liability because you have a debt obligation to the bank, meaning to say you should be paying that one every month or depending on your agreement with the bank. So therefore, you increase as well your liability. That is why you have there plus 3,000 under liability. And the next transaction, on the third transaction, still on the same date, the 2nd of January, the corporation purchased $3,000 of equipment for cash. Now, if you purchase an equipment, remember that you are letting a certain amount of money out from the company's pocket. So there is an outflow of cash, okay? So you have there cash negative 3,000 because you let that amount out from your company's pocket. But in return, in exchange of that cash, you have also but in return, in exchange of that cash, you received an equipment. And remember, equipment is an asset, right? So that is why you have there plus 3,000. And the fourth transaction, still on the same date, the corporation purchased a tow truck for $8,000, paying $3,000 cash and incurring an additional bank loan for the balance. Okay, so let's just do it one by one. The first one says the corporation purchased a tow truck for 8,000, meaning to say there is an outflow of cash. So you let $8,000 out from your company's pocket, right? And also it says paying $3,000 cash. So meaning to say, you also let out $3,000 out from the company's pocket because you are making a payment technically and incurring an additional bank loan for the balance. So if you incur an additional bank loan, you also increased your liability because you have not paid that debt obligation as of yet. So that is why your cash, which is your asset, is negative 3,000. Your check, which you gained because you purchased it, so you have plus 8,000. And your bank loans is, since you have not paid for it yet, so it increased, which is positive 5,000. And on the fifth transaction, on the 5th of January, Big Dog Car Works Corporation paid $2,400 for a 1-year insurance policy effective January 1st. Now here, the asset prepaid insurance is increased and the asset cash is decreased. Now, the impact on the equation, so prepaid insurance, since you purchased it, so you have plus 24. And for your cash, since you let a certain amount of money out from your company's pocket, that's an outflow. So that's negative 2,400. So since the 1 year period will not be fully used at January 31st when financial statements are prepared, the insurance cost is considered to be an asset at the payment date, and the transaction does not affect liabilities or equity. And on the 10th of January, the transaction is the corporation paid $2,000 cash to the bank to reduce the loan outstanding. Again, you paid cash amounting to $2,000. So if you paid cash, you let $2,000 out from your company's pocket, that's an outflow. So therefore, your cash should be negative 2,000 under assets, and your bank loan also decreased because you make a payment. So that is why that's negative 2,000 for your liability, because your debt obligation decreased the moment you paid them. Okay, on the 15th of January, the corporation received $400,000 as an advance payment from a customer for service or services to be performed over the next 2 months as follows: $300 for February and $100 for March. So technically, the asset cash is increased by 400 because your customer make an advance payment. So you receive cash amounting to 4,000, and you have there plus 400 under asset. And continually, it will be earned when the work is performed in later months. So at January 31st, these amounts are repayable to customers if the work is not done, and thus a liability. So the impact is unearned revenue. So that's plus 400 under liability, because that becomes a debt obligation. And on the 20th of January, automobile repairs of $10,000 were made for a customer. 8,000 of repairs were paid in cash, and 2,000 of repairs will be paid in the future. Okay, so there is an agreement here. So you will only be paying a down payment of 8,000 in cash, and the rest will be paid in the future date. So cash and accounts receivable assets of the corporation increase. So you have there cash, since you receive a down payment of 8,000, so that's plus 8,000 under assets, and your accounts receivable, because the other 2,000 will be paid sometime in the future. Okay, so that is considered as an accounts receivable or a collectible of your company. So plus 2,000 under assets. And since you have there repairs, revenue causes an increase in net income, and an increase in net income causes an increase in equity. So the impact on the equation is you have the repair revenue, so that would be plus $10,000. And on the 31st of January, the corporation paid operating expenses for the month as follows. So 1,600 for the rent, since you don't have your own land, you're just renting a space. So that's 1,600. 3,500 for your employee salaries, and $2,000 for supplies expense. The $700 for truck operating expenses, for example, you have the oil, the gas, was on credit. So it was not paid in cash, but on credit. So therefore, if we try to dig deeper, there is a decrease in the asset cash, because technically you make a payment. That's an outflow of the company's assets, and you have there rent expense. So since there is an outflow because you are making a payment on your rent, so that becomes negative 1,600 under equity. negative 3,500 salaries expense under equity still, and negative 2,000 supplies expense under equity, and truck operating expense as well, negative 700. And for the cash, that's also negative 7,100, because a total of 7,100 cash was an outflow. Okay, you let that certain amount of money out from your company's payment since you made a payment for your operating expenses. And for the accounts payable, that would be plus $700, because your debt obligation increases because you did not purchase it. You did not make a payment on cash, but it was on credit. So that makes your debt obligation increase. And on January 31st, dividends of $200,000 were paid in cash to the only shareholder, Bob Baldwin. So dividends cause retained earnings to decrease, and a decrease in retained earnings will decrease equity as well. So the impact, dividends will be negative 200 under equity, and cash, that would be negative 200 under assets. Now, since we have already determined which accounts will affect our assets, liabilities, and equity, the next thing that we need to do, so the various transactions can be recorded in the expanded accounting equation, as you can see there in our example. So you have there in the first column the transaction numbers, and you also follow, as you can notice, we still follow the accounting equation. You have their assets equals liabilities plus owner's equity. So in order for us to be organized, we should write down all the different assets involved in all of our transactions from first to the last transaction. So there are five different assets. We have cash, accounts receivable, prepaid insurance, equipment, and truck involved in our examples. And under liability, we have only three. We have bank loan, accounts payable, and unearned revenue. And under equity, we have share capital and retained earnings. Now, as you can notice, once you have already organized all of these figures, you need to get the sum of each account. Okay, so as you can see there at the bottom part, you have there the sum of each account. Now, as you can see, under cash, you have 3,700. Under accounts receivable, you have a total of 2,000. Under prepaid insurance, you have 2,400. And under equipment, you have 3,000. And under truck, you have 8,000. Equals your bank loan sum, that would be 6,000, accounts payable, that would be 700, and unearned income 400, plus your share capital sum, that would be 10,000, and retained earnings sum would be 2,000. So if you try to calculate everything, your total assets, that would be $19,100, which balances your liabilities plus owner's equity of $19,100. Okay, so that's what we called double entry accounting. Okay, this is another way to look at it. All right, I think that's a good place to stop. If you have questions, please let me know on the comment section below. And if you like this video, please don't forget to subscribe and hit the bell button for the latest updates. Thank you.